don't have hours to spend on forex trading, no problem. In this video, I'm going to show you how to trade very efficiently using an effective and simple time-saving strategy. So, the simplified strategy. The first part is liquidity sweep. The second part is change in market structure. Then you have market entry. I'll show you where to put your stop loss and where to take your take profit. You need to watch this video from start till the end so that you don't miss any important part. The first part of our simplified trading strategy is the liquidity sweep. So, what is a liquidity sweep? A liquidity sweep is simply when a swing high or a swing low gets taken out. So, what is a swing high? A swing high, as you can see from the diagram shown, is a candle that has two lower wick candles. A swing low is a candle that has two higher wick candles. As you can see here, this is a swing low. So in our strategy, we are going to focus on the 15-minute liquidity purge. We wait for liquidity to be taken out in the 15-minute time frame. The reason why we focus on liquidity purge is because the market liquidity never lies. The second part of our trading strategy is the change in market structure. So, what is change in market structure? Market structure change is the change in the state of delivery. So, this simply means that if the price was going up, it changes direction and starts going on the opposite side. If the market was going down, this means that it changes direction and starts going in the opposite side. How we can tell if the market has shifted structure after liquidity has been taken out in the form of a liquidity purge is simply checking how the candle that takes out the liquidity closes after. In this example, we see that the liquidity has been taken out, but the candle that takes out the liquidity, it closes above the candles where the liquidity lied. So what does this mean? This simply means that the market has shown a strong signal for buying. In this next example, the market takes out liquidity, but it closes below. So here we do not look for buy setups because the price has closed below and created a lower low, which signifies that the market is likely to start going lower. After the liquidity has been taken out and the market structure has shifted, the next part of our trading strategy is to look for market entry setups. The next step is going to lower time frames, and in our case, we utilize the 1 minute time frame to look for places where we can enter into a setup. The places where you can enter into the setup are on a 1 minute inversion fair value gap. So, what is an inversion fair value gap? A fair value gap is simply a void or space that was left by the price as it was going up or down. Normally, the price moves in steps with one candle opening at the price where a previous candle closed and vice versa. So, fair value gaps are when the price moves so fast in one direction and instead of following the normal pattern, it jumps and opens on the next candle, leaving behind little gaps that can be seen in each time frame as shown in the example. With that understanding of what a fair value gap is, we can then move on to an inversion fair value gap. Inversion fair value gap is a fair value gap that was formed the first time and then it got violated when the price traded through it. In this example, the inversion fair value gap is the area that is shaded green. It was formed by the red candles when they were going down. The price then goes up as shown by the green candles. Then the pointer with the hand shows the price coming back to the inversion fair value gap. So an inversion fair value gap is simply a fair value gap that has been traded through, and then the price comes back and uses it as support or resistance. After getting into a trade setup, the next step is to know where to put our stop loss. For this model, you should have your stop loss just below the candle that has formed the inversion fair value gap in the 1 minute chart. In this example, when the price comes back to the inversion fair value gap, which is the area that's shaded bluish greenish, we get into a buy setup. Then the stop loss, we place it just below, a few pips below the candle, the third candle that forms the inversion fair value gap. So having a stop loss is important as it protects the money that you have in your account. The other important point is to never adjust your stop loss, because this increases your risk. I have learned this lesson the hard way. So please do not adjust your stop loss. The last part of our trading strategy is where to place our take profit. The take profit level that we will use in this model is a 15-minute fair value gap or a 15-minute swing high or swing low. The first take profit level in the example above is the 15-minute fair value gap that has been highlighted and shown by the pointer. The next point that you will take your profits in the example above is on the next highlighted fair value gap that's also shown by a pointer. The final point that you can use to take your profits is the 15-minute swing high that is shown by the green dashed line in this example. Now I will show you how to use this strategy on the chart. In this example, the area that's marked with a line shows a liquidity purge, but the candle closed below the liquidity. So as you can remember, we don't put a setup here because this is a signal that the price might start delivering lower. In this next example, the liquidity has been swept and the price closed below. So here, as you can remember, we look for entry setups to continue with the price trend which was going down. So after the liquidity has been taken out, you highlight the wick because we want to get into discount levels. So after you mark it like this, you go to lower time frames. As you can see in the lower time frames, the area where we highlighted, we now start looking for inversion fair value gaps and wait for the price to go back to the inversion so that we can get into a sell setup. When the price goes back to the inversion fair value gap, which is marked by the yellow shaded area, we get into a sell setup and we put a stop loss just below the candle that formed the inversion fair value gap. And the take profit, if you can remember, we look for fair value gaps in the 15-minute time frame or swing lows or swing highs. In our example, there's no fair value gap, but we have a swing low. So that is where we will take our first take profit. If you have made it this far, congratulations. Go through the model again until you understand it. Also, if you found this video helpful, please don't forget to like and subscribe. Bye.